Hi guys, my name's Jeff. I have an MBA in finance, and today I'll be talking about the stock market. This is primarily directed to people who are just beginning in the stock market and want to learn some basic pointers on how to execute a trade and generally what they're looking at when they're at the trading screen. If you do not have access to a trading platform, I'll also explain how these trading platforms work and what to kind of look for in a trading platform. So let's begin. So I have a few disclosures here. Please read them and refer to them. Basically, I'm not liable for anything that you do. I'm not liable for any of your losses. Invest in in the market at your own risk. I am not a licensed investment advisor or financial advisor. I'm just merely an amateur investor, but I do have a business degree. Also, I use some affiliate links throughout some of my material here, and I do receive commissions off of those products or services. So let's begin by talking about some basic concepts that we're going to cover today. So we're going to talk about trading platforms, account types, and understanding trade orders. And this will be part of a bigger video series I am doing, but I felt it was very important because as I go and talk to some people that are beginning investing, they're kind of, dipping their toes in, so to speak, and trying to understand what generally these things mean. So trading platforms, kind of back in the early days of online trading, or retail trading as they call it, had commissions on them. And the commissions would allow the trading platform to kind of offer some premium execution of the payment order flow. So what is a payment order flow, and how do these trading platforms make money, or specifically the commission-free trading platforms? So Robinhood was probably the biggest known commission-free trading platform that kind of propelled this movement, the commission-free trading movement, and kind of forced the other brokerages to follow. So Robinhood was the first to offer commission-free trading, and now we have companies like Webull, TD Ameritrade, E-Trade, Charles Schwab, all offering commission-free trading, or near commission-free trading. But how do these platforms actually make money? And so we're going to talk about how they do that here. So platforms make money from interest and margin lending. So a margin account, which we'll talk about here in a minute, a margin account basically is kind of a loan account that allows you to borrow money to invest or trade with, or perform certain exotic trades with. We'll cover that here in a minute. But think about a regular bank account, or a regular bank. They have a loan. You have to pay back interest. So they get that margin lending interest there. Also premium upgrades. So like Robinhood has like a gold package, or they offer some other features, reports and analyst reports and stuff like that, so they make money off of that too. Rehypothecation and payment order flow. So I'm going to first cover payment order flow here. On the right here, you'll see a typical payment order flow for how a broker sends your transaction to the marketplace and how it gets executed. So first, the investor, or you, place the order with your broker. So Robinhood, TD, Ameritrade, E-Trade, you name it. And that broker then typically sends this to an internalizer. And this internalizer uses algorithms and data feeds to figure out how best to route that transaction. So you got to remember, though, they're doing this for you for free. So while they're doing this, they have some interest in mind to make a little money off of that transaction. So let's take this hypothetical example. I am going to buy $100 of Apple. So maybe Apple's trading at $100, so $100 a share. And I submit this order. It goes out. It goes through the internalizer. The internalizer comes back and says, okay, you just bought $100. We're going to execute this $100 market transaction, but we're going to buy it at maybe 100.001 or $100.008. So they made a fraction of a penny off of you. So now multiply that by millions of transactions, and you have a pretty good idea of what they're making and why they offer this to you. So they can either do that, make the money off of that, or typically they can also offer to route it to a marketplace and not take their price of it. So typically some of these internalizers have a portfolio or a bank or an inventory of stock that they have, and they will sell it to you and take a little kind of commission off of it, if you will, by disguising that in the order flow. Whereas route to marketplace, you're going to pay the market rate. Rehypothecation, so this is for margin holders, which we'll talk about here in a minute, but rehypothecation allows the broker to use your assets in your account to fulfill their own obligations. So they could take some of your assets in your account behind the scenes and invest it in other securities, or do whatever they want with it, pretty much, and then turn around and then pocket a few pennies or whatever they made on that transaction and put it back in to your account, without you really seeing that happen. It all happens behind the scenes. Nothing really changes in your value of your portfolio, so to speak. It's just stuff behind the scenes that they're doing to make money. So, with the recent debacle going on, a lot of people are switching to Webull. So Webull has an offer going on right now where you get 4 free stocks valued up to $3,700, and that's I believe they have an offer where you get 2 free stocks by simply opening an account and setting up a brokerage account with them, and then you can get 2 more by putting in $100 or more, and you can get the other 2 free stocks, and you can get upwards of $3,700 in stock. So I use my special URL here, bigdealio/Webull, to sign up. So let's talk about account types. As I alluded to, we talked about margin accounts here. So let's talk about what a cash account is and a margin account. So a cash account basically is what it is. It's an account that the transactions have to be made with the available cash or positions in the account. So meaning that you cannot borrow against a margin or against the broker to get into new positions. So say you had $1,000 in your account, you bought $500 of a security, you have $500 left in your account, and then you sold that security, say, 100 days later, maybe you made, $1,000 on it now, so now you might have $1,500 in your account. But what will happen is that profit or loss, whatever side you're on, will not be available for trade immediately once that security is sold, because it has to settle. It has to go through a settlement process, so it's not immediately available. Now, like Robinhood, for example, automatically tries to put you into a margin account when you sign up. That's the default thing, and they offer like instant access to cash or whatever the terms they use to market that. But basically, you are enrolling in a margin account, which has some other restrictions on it. I want to also talk about a rule of pattern day trading, or PDT. So basically, it says that people tend to get into the PDT issue when they are are new here and doing day trading for the first time. And so basically a pattern day trade rule is if your account is under $25,000, you're limited to 3 round trips every 5 days. So what is a round trip? Basically, okay, so in a 5-day period, maybe you buy or sell a security. So for example, you may have Apple, and you buy an Apple on day 1, and then you sell it. And then on day 2, you buy it again, and you sell it all. And on day 3, you buy it again, and then you sell it all on the same day. Those are round trips. So also, or day trades. So if you buy on Monday and sell on Monday, it's a round trip. But if you buy on Monday and say sell on a Tuesday, that does not equal a round trip. Same thing for the other days. So if you buy on, say, Wednesday and sell on Wednesday, it's a round trip. Buy on Wednesday, but you sell on Thursday, that's not a round trip. And so you got to keep that under wraps. You got to understand that because certain platforms will limit you. Well, actually, it's an SEC rule, pattern day trades, PDT, and so platforms will generally lock you out for a period of time, like 90 days. So I don't think you can buy during those periods. I believe you can only sell during those periods. So you can get locked out. So let's understand the basics of a trade order. So we're going to talk about just basic trade orders today, and then later on I'll do another video on the more exotic trade orders, and how to do things like stop losses or how to protect and mitigate some of your risk in the market. So first we're going to talk about market orders. So market orders, basically you're going to buy something or sell something immediately at the current price. So it's guaranteed to execute. So as you see here on the right, there's no price. It's basically, I'm going to buy 10 of this 10 Apple shares, and I'm going to pay whatever the current price is, regardless if it's going up or down. So in order to fulfill those trades, so maybe the price, we'll just use some simple numbers here. So maybe it's able to get 5 shares at, say, $100.10, and it's able to get 5 more shares at $100.11. So it will buy those shares as soon as it can, using all the routing and the technology there to match that up. Conversely, limit orders basically prescribe a price that you're willing to pay or sell the security for. And these work also on both sides of the transaction. So if we go back over to the market orders, so you can either do a buy market order or sell market orders. So you can click on sell, and you can play both sides of that. So if you're going to sell a market order, you're going to sell immediately, and it's going to pick whatever the market price is. So let's go back to limit orders. Here, you can also take the both sides of limit orders too. So you can do the maximum price you're willing to pay. So in this, I am willing to pay $131.80 for this asset or security. I'm going to buy 10 of them. So maybe it's trading at like 120, maybe it's trading at 132.80 or 133, and I think it's going to go down a little bit. Maybe I can grab some stock. I can put a limit order on that and maybe get a little discount from where it is. But if it never goes down to 131.80, I won't be able to get it. Conversely, a sell, on the other hand, is what you're willing to sell it at, the maximum price. The minimum price that you're willing to sell the security for. So say that you are conversely at this, where it is trading at say $135, and the stock price is kind of fluctuating, and you're like, okay, I'm gonna sell this if it goes down to 131.80. I execute a limit order here, and if it hits 131.80 and I'm able to sell it at 131.80 in the market, it will do it. So it's not a market order, it's a limit order. So it's going to try to match up the shares that are available, or buyers that are available to buy it at that price. However, in the event that it can't find anybody and it drastically goes down, it's not guaranteed to execute. So let's also talk about the other item here. Time and force, right here on the screen, indicates how long this order will remain in place before it's executed or it expires. So common times of force are day, or GTC. So a day, basically during normal trading hours, this would execute. GTC is good to close, and typically that will give you a closeout date on that will allow you to have this order available until that order expires. So I hope you enjoyed and gained some knowledge out of this. Again, if you don't have a brokerage account, head over to bigdealio.io/Webull. That's bigdeal.io/Webull, and sign up for a Webull account. As always, please like, share, and subscribe. I've also attached a special offer in the description for a basic stock market terms and concept guide that you'll get 50% off using my link. This is a guide that I have written, so check out the description, and we'll see you next time.